good predictor of future performance. So let's take a look under the hood. You're looking at fast graphs here, my favorite fundamental analysis research tool. Probably grown accustomed to this if you frequent this channel, but I'm going to break down what we're looking at here. I have the stock price off the graph for the moment. The green shaded area represents the EBITDA per share growth for this time period, starting back in July of 1999 all the way up to present. Save for this period here on the right in the lighter shaded area, which is analyst projections going forward. I'll cover whether this is accurate or not in a minute. Now, we could be using adjusted operating earnings, operating cash flow, free cash flow, or other metrics, but the correlation to this stock price seems best with this metric, EBITDA per share. The tighter the correlation, the better we can assess the current value of the stock. It is worth pointing out the free cash flow substantially covers the dividend. This white line here represents the dividend payout. You can see how it's increased over time, even through rough times like the Great Recession. Another way to visualize this is by throwing the dividends on top of the graph. The lighter shade of green here is what is getting paid back to shareholders. You can see how it's increasing each year. I'm not the biggest fan of this view. For me, it manipulates how I see the graph, but it might be better for some of you to see, so it's worth looking at. But I'm over it, so let's take it off again. Now, let's focus in on the chart to the right of the screen. You can see the stock price as of this recording is $155. The blended price to EBITDA ratio is 19.21. One way to think of that is how much you're paying for $1 worth of earnings. 19.21 is the multiple applied to that $1 of earnings. If you look down in the blue box, you can see that for this period, the normal price to EBITDA ratio is 16.41, which means Microsoft is selling at a premium right now relative to itself for this time period. Contextually, this isn't surprising as you can see the earnings are accelerating here, so it would be expected that investors are paying more now than in the past. This normalized price to EBITDA also adjusts as you change the time period. Interestingly, the 3 to 4 year normalized multiple is spot on with a longer time period. Also, notice how the EBITDA growth rate jumps from 10% annualized to over 26% when you zoom into the more recent part of the graph, hence why you're paying that premium. Looking back to the chart on the right, the current dividend yield is 1.31%. Yield hunters will scoff at that, but I believe I've already illustrated how much those dividends can add up over time. This is why yield hunting can be detrimental to long-term gains. Moving down, you see here the market cap is $1.18 trillion. Yeah, trillion with a T. The enterprise value is actually less than the market cap. Basically, this means the company has more cash on hand than debt, which could also mean the company is undervalued. Either way, it's a good sign during times like these to have more cash than debt, obviously. Just to compare it to an extreme example, AT&T, seen here, has a $206 billion market cap and an enterprise value of $405 billion. Yeah. AT&T has a lot of debt. More than any company in the world, I believe. I think it might be one or two. Hell of a dividend yield though. Buyer beware. All right, moving on. Long-term debt to cap is 39% and the credit rating is AAA. Pretty good. Okay, let's see what this thing looks like with the stock price thrown on the graph. A little expensive. Looking to the left, the dot-com era, also known as the irrational exuberance period, you can see how the stock got very expensive relative to earnings. Back to the right, looking at the current period, we're expensive, but not nearly as much. Just to illustrate the difference between buying this stock when it's expensive versus a more fair value versus undervalued, it's a difference of 6%, 14%, and 19% annualized returns, respectively, not factoring in for reinvested dividends. When we chop the irrational period off the graph, the current period looks even more expensive. But we have to point out that the company has evolved with new revenue streams starting around this period. If we chop more time off, the picture begins to look a bit better. Future returns off of analyst projections look good. Let's take a look to see how they've done in the past at predicting earnings. Looking at the analyst scorecard, they have done a pretty good job the last 3 years, but before that, it's mixed with some pretty big misses. But remember, the company economy was evolving a lot during this period. Worth mentioning, this is their 1-year forward projections for EBITDA per share, which analysts have had a better grasp on in recent history compared with other metrics. So considering this, moving to forecasting and choosing a multiple near the current value, you're looking at low double-digit gains. Some multiple expansion, which isn't out of the question, shows 25 to 35% gains, and if this stock returned to a more historic price multiple, near-term gains are pretty flaccid, and further multiple retraction would result in losses. You have to assess for yourself what scenario you think is more likely to occur in the future. Microsoft, Amazon, and Google are all well positioned in this COVID economy. Search, streaming, gaming, telecommunications, cloud, productivity software, e-commerce, and delivery, basically the glue of the economy right now. The problem with Microsoft, Google, and Amazon is the consensus of high expectations. I spoke about what this means for potential returns in previous videos. I wanted to highlight Comcast here, which may represent a better balance between risk and reward. Let's tackle this real quick. This chart looks amazeballs. Spectacular earnings growth here. The brunt of Comcast's revenue comes from broadband internet services, which is very important right now. They have an effective monopoly or near it in many municipalities. They also have video streaming plays as well, and they still have a stake in Hulu. For the moment, I believe they might be selling it to Disney in the future. On the bearish side, Universal Studios is completely shut down right now, and it doesn't make up a significant portion of the revenue, but it's worth mentioning, I think. I think the biggest bear thesis is 5G. 5G may directly impact their largest revenue stream, but Comcast doesn't seem too worried about this. CEO Brian Roberts says 5G services isn't cheaper, faster, or better than high-speed landline broadband services from Comcast. And he goes on to say wireless carriers are hoping to use 5G to get to speeds that they're at today, but by the time they achieve this, Comcast will be even faster. He continues by saying there's nothing more reliable than wire, and he notes that Comcast's heaviest power users consume 100 times more data per month than the average mobile user. And this trend is growing, especially right now. The current dividend yield is 2.71%, compounding growth rate is 19%, and the payout ratio is just 27%. This is spectacular. Now let's throw the price on the chart. You can see it was overvalued going into the Great Recession, and this hurt share price returns. Let's cut that piece off. You can see here clearly the stock looks overvalued. Analysts have been pretty good with their 1-year forward projections. The biggest concern I have is their debt load, but they do have an A- rating and amazing cash flow, most of which is coming from the side of the business that is doing very well in this COVID economy. All right, finally, now for that mystery chart from last week. This company's stock returns have destroyed Amazon, Google, and Microsoft during this last decade. And the answer is Domino's Pizza. Who would have guessed? Not something I'd recommend now, but pizza does sound really, really good. If you're ordering, guys, support your local pizza restaurants if they're still serving, that is, and stay safe. That's it. I'm Nick. This is my lemonade stand. None of this is financial advice. See you guys on the...
I mean, does it deserve to trade at a richer forward multiple than Alphabet?
Yes.